Forget the Bitcoin hype and those really too good to be true annuities. I can tell you, chasing shiny objects will not secure your financial future. Are you wondering how to navigate inflation and taxes and healthcare costs instead? Today, I'll be equipping you with the tools that you need in order to build a solid financial plan. Really, after this video, you'll have a good understanding on all of the things that your financial plan needs to succeed. So, too often, what I see is individuals and/or their advisors get too caught up on selling what I'm going to call the tools today. And tools are just all of the investment options that are out there. And we run into scenarios where there are these shiny objects. And these shiny objects are based around two big components. And that is fear and greed. So first, let me talk to you a little bit about the greedy, the greed shiny objects. And these are, always in the media. You're going to read about them in newsletters, emails, things like that. Your advisor may or may not be pushing these types of things to you based on prior results, things of that nature. So the big ones we're seeing right now is the AI boom. And, nothing wrong with AI. We believe fully in AI, and AI is going to be a big part of the future. However, a lot of times an advisor can use AI to sell a product, sell a stock specifically to you. That's chasing a shiny object if it's not really built into an overall plan. Bitcoin or any other cryptocurrencies that are out there, there could be a place for those in your portfolio or your investment plan, but many times it's kind of presented to you in this shiny object, and it just sounds so wonderful, and you can't miss the boat on this. You have to jump in. The gold boom that we've seen over years, when things start to get a little hectic in the markets or crazy, you'll start seeing all the people who are offering gold coming out of the woodwork. So this is a shiny object. Another really big one when we're talking about chasing shiny objects due to greed is looking at prior year big return investments. Hey, Mr. and Mrs. Jones, this stock was up 30 or 40 or 50% last year. This is why we have to jump into this, this year. Or, even looking at 3 years ago, last 5 years, comparing what happened in the past and chasing those returns in the future usually could derail you and ultimately lead to losses potentially if you're chasing those returns. Second big thing is, as I mentioned, fear. And, we're seeing a lot of this now. For example, markets kind of run high, and you look back in the past couple of years, we've heard nothing but recession, and all of a sudden you have the advisors who are coming out offering annuities that have all of the upside in the market but no downside. They almost sound too good to be true. That's usually the case. So if you're kind of being offered or you're looking into a shiny object that sounds too good to be true, proceed with caution. Get a second opinion on that. Make sure that you're reading all the fine print that goes along with it, especially with annuities on that. Tax-free, another big one, shiny object. Tax-free investments can be out there, such as municipal bonds, things of that nature, but you have to understand your tax situation first to determine, do I need this tool to fit into my plan? Bonuses and insurance things, moving all of your investments because you're worried about market decline into something safe such as insurance or things with bonuses or back to annuities. This is chasing shiny objects. And when an advisor can, feel the fear in the market, this is a prime time for them to kind of come out and start selling these types of shiny objects. So again, as I mentioned at the top of this, is do not get caught up in the tools. You have to focus on the strategy first. So now I want to talk to you about that. When we think about strategies, there's multiple components that come to this. And the first one starts with income planning. Many individuals, when they're building out a comprehensive plan, they have to start with the income planning side of things. Do they have enough money to live their life as they wish without having to worry about running out of money? Two big components that we look at in income planning that need a strategy are inflation and tax efficiency. So if we've determined that income planning is important to us, now we can start looking at those tools, the investments, and how they can fall in line to that income plan. But don't work the other way around. Too many times people are sold a product or a tool first and kind of force it into the plan. It's very important that you focus on the plan first and the strategy, and then let the tool, kind of fall into line from there. So investment planning, this is another big strategy component. And again, two things that we're looking at here is risk capacity versus risk tolerance. I'm here to tell you that there's a major difference between those two. Risk tolerance is the one you hear the most about, and risk tolerance is ultimately your appetite for risk. So you as the individual, when are you picking up the phone and saying, I can't handle this much, loss if you're seeing a decline in the market? So it's really just understanding what your appetite is for that risk mentally. Risk capacity is determining, based on your plan, how much risk can you afford to take? Meaning, let's say 20% of your portfolio that you have built up can take care of your income for the rest of your life. So going back to income planning, you've identified that 20% of your portfolio is designated for income. That means that you have 80% of your portfolio that's going to be a little more geared towards the investment side, can be a little more growth oriented. That 80% you now have what I would call risk capacity on. If the markets were to decline, it's not impacting your daily living, it's not impacting your income, so you can afford to take risk on those dollars. You've afforded yourself time to let those dollars, ride with the market a little bit. So again, we can grab the tools that fit into your investment plan based on your risk tolerance and your risk capacity. The next one that really needs a high focus on strategy is tax planning. And, there's a major difference between tax preparation, which is more reactive, that's looking backwards on what already happened in a prior year, versus tax planning. Tax planning requires strategy. That is looking at what your tax liabilities could be, next year, 3 years from now, 5 years from now, 10 years from now, all the way to looking at future legacy, on kind of what is getting left behind to your heirs, your children, your charitable donations, whatever it may be. There are tax planning strategies that can be used, and guess what? There's tools that can also be pulled in for that planning. But it's important to understand your tax situation first, and then start using some of those tools that may work the best. Next piece of, call it strategy planning here, is healthcare planning. And main strategy focus here that I'm going to talk about in this video is long-term care. You can have the perfect plan in place, and you have a great income strategy, you have a great investment strategy, your assets are doing well, you're minimizing your tax liability, but then your health fails you, and you go into a skilled nursing home facility, or you need at-home care, things of that nature that are very costly. If you didn't have some sort of plan in place, that can derail your overall financial well-being at that point. So there's strategies that we can use. There's some of those shiny, potentially those shiny objects that maybe sounded too good to be true if they were sold to you in the wrong way, but maybe they're actually good for specializing in long-term care, not, high growth or things of that nature. So again, we can pull some of these tools off the tool bench here to focus on that long-term care strategy. Last one that requires, in-depth strategy planning is your estate. And this is simply dotting the I's, crossing the T's, making sure that all of your, call it your net worth, is passing on exactly as you wish and really as tax efficient as possible. So this is looking at, just getting your basic living wills and power of attorneys and things of that nature in place. Also starting to focus on a strategy if leaving money behind to your heirs is important. What are some of the tools that can be used to provide a higher legacy, and again, in maybe a tax advantageous way? So hopefully you're seeing the kind of trend here is that really all 5 of those key planning areas can kind of commingle themselves. And, when we talk about legacy, taxes are a part of that. When we talk about income planning, taxes can be a part of that. Again, we talk about the investment side of things. It's really based on what your income needs are to determine how much can you take risk on. So moral of the story in today's video is get a plan in place. It starts with understanding your goals, your objectives, and really starting to determine what strategies you need to plan for the most. And that should be the primary area that you focus on developing a comprehensive plan around, is those strategies. And I can't stress it enough, the tools that can be used, some of those shiny objects that I talked about, I'm not necessarily down on, it's just they have to be used with purpose. Too often, I meet with individuals and I ask them why they own one of the investments that they have, and they don't have a clue. They don't understand what the purpose of that was. It was just kind of sold to them as a shiny object. So do not fall victim to chasing shiny objects, whether it's due to greed or due to fear of the market. Get a plan in place. I have a great video right here, the top 4 retirement planning mistakes you need to know about that can help you avoid any other mistakes that could wreck your financial plan. Thank you and see you next week.